Hey everyone, thanks for tuning in once again. This is Ben Morales, your personal financial coach and consultant. And today I want to share with you a personal story. I want to tell you the story of my daughter and how we use the velocity banking strategy to help her more quickly and efficiently pay off her student loan debt. The reason why I wanted to do this video is because I was looking, doing some research on the internet, and I came across an article that's called Four Ways to Pay Down Student Loan Debt Faster. So that piqued my interest, and I started to read the article. And as I was reading it, I really said, wait a minute, I know what they're saying in terms of making bullet points. Maybe they're just trying to get views for the article, but I didn't feel like it really was being impactful. And I didn't really feel that it was going to help anyone who's looking to pay off their debt, student loan debt faster. So I want to talk about why student loan debt is difficult to pay off and how it's structured. So this is the scenario for my daughter. When she started in college, it was the year 2014. And if you can see in 2014, the interest rates were just 4.66% for FAFSA, for student aid, financial aid. And the way that is structured is you finish your college years. As you go on, they disperse your semester. For every semester, you get financing. You have to apply, and if you're approved, every single year, they tell you this is what you're going to get semester number one. This is what you're going to get semester number two. And so that's how they did it her first year in the university. Thankfully, the second year, 2015 is 2016, the interest rates thankfully had dropped. And here you can see that the sum of money was pretty much the same that she was getting. And again, they dispersed it the same way for her. Now, in 2016 and 2017, you will see, and this is how the system is set up, right? Not only did the interest rates increase, right? But now she's no longer an undergrad, right? Now she's basically getting closer to graduation. So she's getting loans, but the problem with these loans from this year to this year is now it's unsubsidized. And if you have student loan, you know exactly what that means. Unsubsidized means that you are accruing interest from the day the semester starts. As soon as that loan is dispersed to you, you start to accrue interest. So by the time her 4 years were up, when it was all said and done, she owed, I put down 27,000. It was a little bit more than that. So again, in the grand scale of things, it wasn't a lot, but I will say that if you don't start paying off the loan, the student loan back immediately, you know that you're going to be starting accruing interest 6 months later, guaranteed, whether it's unsubsidized or not. So we wanted to help her to avoid that because we didn't want her to be in a position where she's paying loans off of a very long time. Now, what was the solution for that? Well, first, let me talk about the solutions that the person who wrote the article. She says, number one, put any extra money payments toward the principal. Okay, so yes, that does make a lot of sense. You want to apply it to the principal, not the interest. The problem is that if you simply, and this is what she says in the article, right, while making extra payments toward your student loans might seem like an obvious way to decrease your debt, what might not be so obvious is how, right? How you apply those extra payments. And I talk about all the time in this channels, how you borrow is more important than what you're being charged for borrowing. So how you make it extra payments is more important. If you simply submit the extra money on your account, your servicer may use your extra payment to advance your due date. And it says applying the extra amount to next month's payment, which actually won't help you pay off any student loans faster. Okay, that is because your extra payment will first go to any late fees and accrued interest before hitting your principal. Remember, lending institutions are for-profit businesses. They want your money up front. So moving right along here, here's the second suggestion that she makes. Make payments on a bi-weekly basis, which is a good idea, but the challenge is instead of making 13 payments, you end up making 12 payments. And another thing that complicates it is which one are you going to pay first, right? You're already accruing interest on these. And as 6 months pass by since you graduated, you're going to be accruing interest on these as well. To complicate matters even more, when it comes to financial aid, you can have 4 or 5 different service providers for the loans. So that makes it even more difficult. So Where do you even know how to apply that? So that makes it even more difficult. I love her third solution. The third solution is this: enroll in auto pay. Well, who's it really benefiting, right? Auto pay does, yes, it gives you the sense that, okay, my payment is going to be made on time. I'm not going to be subject to a late fee, but is that really helping you pay it down any faster? No, it's not. All it's doing is making sure that your payment gets down on time and that the lending institution gets their money first. And number four is even more ludicrous than all the other ones. Consider refinancing. Well, if you watch this channel for any length of time, you know that I never recommend for you to refinance and do a loan, which is what she's stating to do, because you're going to get, in this case, an interest rate higher than 6%. Think about it. You're in college, you just graduated, you're just getting your first job. Most people don't have credit at that time. What do you think the interest rate is going to be in a loan? It's probably going to be double digits, right? It's going to be way higher than the 6% that you were getting from the financial aid package that you had. So that is a big no-no. If you could even get applied for it, you're probably going to have a double digit, maybe 9, if you have any kind of credit history, or 10%. And that's what makes it difficult for you to pay off student loan. And they know this, right? They know that if they can't get you on this end, they do a private refinance, which is what she recommends, into the loan, and you get stuck in that loan even a longer time. I'd like to just share with you some of the things that my daughter did to help her pre-position her to be able to pay off her student loans a lot more quicker, really truly faster than the 4 suggestions that the article talked about. By the way, before you just hop on board with any idea that you read on the internet, or even what you see on my channel or any other channel, for that matter, see where the source is coming from. Continue to do your research around it. I found out that that article was pretty much written by an editor who used to work for LendingTree. And if you know anything about LendingTree, they are a online lending company, and they offer people loans. So if you watch my channel, you know I don't suggest that you go to loan, because loans are amortized. So let's talk about what was the answer for my daughter. So some of the things that you can be doing as well while you're in college, right, to help pre-position for you so that when you finish school, you're able to more quickly and efficiently pay off your loan. And the first thing is you got to work on your credit, okay? Build your credit up. Build up credit, right? And this is the reason why this is really important, is because if you'll notice here, every year that you're in college and you're getting that financial aid, you're getting a loan, okay, that's being offered to you. And the way that a credit report reports your credit score, a lot has to be do with it, especially when you're this young and you're just starting off, is they use what's called a utilization rate. And if you start getting loans every single year, what's happening is each of these loans is being reported to your credit report, and it's going to show up that you have 8 different loans, and all 8 loans are maxed out. So when you have a maxed out loan, your credit score will suffer tremendously because of it. So when you get to the end of your college career, and if you have done nothing else but only have loans reporting on your behalf, you will have a very poor credit score when you finish school. So my advice to you would be, while you're getting these loans dispersed to you, you're also going to continue to get offers from credit cards. You're going to continue to get offers probably from private student loan companies. So the easiest thing to do is start to take accept the offers that they're giving you for the credit cards. But I would say, be number one, only take the offers just to establish a different line of credit, right? Because when you're young, you're not going to get offered a long or high line or high limit of credit. So be smart about it, right? Don't be afraid to use credit. Just use it wisely. If you start getting offers, you want to look at who the offer is from, right? If you can get a offer from a really strong bank like Chase or Bank of America or Wells Fargo, companies like that, banks that have real good, strong credit ratings, take that offer, not to use a credit card, right? But merely to start giving yourself another avenue of credit, because trust me, if you have nothing else at the end of the 4 years, you will suffer. Your credit score will suffer. It's going to be very difficult for you to get this loan that they want you to get. It's going to be very difficult for you to get any other kind of financing. Now, number 2, Get a job. Okay. Get yourself a job. And my daughter, when she was home during the summertime, she worked a job. While she was at school and not studying, she worked a job. Why is that important? Because she started to tackle all these loans little by little, especially these right here. Because after her second year, these loans were already unsubsidized, and that's where she was getting charged interest rate from the minute that they gave her the loan. So if you can get a job, it doesn't matter how small, it doesn't matter how much you're getting paid. Get a job while you're studying and start to make as much payments, applying them to your loans, okay? Especially the subsidized ones. Number three, not only while you're paying off the loan, stay save, okay? Save as much as you can. Save. Work on credit, yes. Work on building your credit. Work on paying credit off, but also save, right? It's important that you can save. In 4 years, right? You're gonna have a lot of birthdays. In 4 years, right? You're gonna have a lot of Christmases. In 4 years, you're going to have a lot of opportunity. You're going to be receiving a lot of gifts, right? During those 4 years, at least I give you twice a year, your birthday and Christmas, right? And instead of a physical gift, ask for cash. Ask for cash so that you can just put it right back to paying off this interest rate. Because remember, these loans are going to be under your name, and you're just starting off your credit career. It's going to be very difficult for you if you don't take some steps. You'll be disappointed when you finish the 4 years and you don't have some of these things in place, because it's going to work against you. So in between this, building up your credit, getting a job, saving what you can make a difference. Once you finish your college, right? You finish with your career, you do have a window, right? You're going to possibly have to wait. You're going to wait at least 6 months before you have to start making payments back on these loans. So use that time wisely. I guess I could add that, right? Use time wisely, right? While you're doing these things, while you're building up your credit, get that job, save as much money as you can, and use the time wisely. So in her case, she graduated in May. 6 months passed by, which took her to November. From 6 months that had passed by, she wasn't in the job that in her career at that time, but because she had already established a summer job when she was here at home, she was able to return back to that summer job. And in those 6 months, right, while these were being held off and they were being deferred, she saved $10,000. And one of the reasons why she wanted to do that is she can go and buy a vehicle. But this is where not only being using your time wisely, it's also using your money wisely. So what was she able to do, and how was she able to pay off her student loan debt in a more quickly and efficient way? Well, this is where the velocity banking strategy came in. So if you watched this channel before, you know that one of the great things that you can leverage is a debt tool. In her case, what we leverage was a personal line of credit. Okay, personal line of credit is just like a credit card. A personal line of credit is also like like if you have a home equity line of credit, meaning that the interest is paid on an average daily balance, and it's a line of a set dollar amount. Again, I talked to you earlier about when you're finishing college, you're not going to get approved for the highest amount of loans, especially if you haven't done anything while you're in college to improve your credit. But thankfully, she went to PNC Bank. Okay, shout out to PNC. Applied for a $15,000 loan, and she got approved with an interest rate of about 10.5%. Now, this was the change as well. I talked to you, and I've done many videos about why you should not leave your money in the bank. It was very difficult for her, but in spite of all of that, what we did is reposition her cash flow. So when she finished school, she was already accruing $27,000 of it, or she was already accruing interest on the $27,000. So, and again, this is a simple solution, right? If you're studying velocity banking, it doesn't have to be a difficult thing. It's just about repositioning your funds. So here's how she did it in a very short amount of time. Instead of leaving her money saved in your savings account, applied it to the student loan debt, right? So if you're in student loan and you have $10,000 of savings disposed, right? Well, what's going to happen? You have 3, 6, 9, right? You want to tackle these because obviously these are already unsubsidized and they're accruing interest. So not only did she eliminate $9,000, or actually a little bit more in student loan debt, because she repositioned her savings and she applied them to her student loans, right? So that brought her balance down to 17,000. Now, what's the next step? Well, with velocity banking, the advantage of using a personal line of credit is that money is going to be available to you when you pay down that personal line of credit. The next step was to take $10,000, another 10,000, right? Which was now eliminating this one, and this one, eliminating uh, the other debt using internalized $10,000. What we're doing is chunking away at that, and now she's paying back this personal line of credit from PNC every time when she gets paid. When she got paid, rather, she paid the personal line of credit, right? She still continued to pay, but now look at what's happening. She's only paying loans to two federal or FAFSA loans. She's only paying two loans here, and the majority of her income was being applied to the personal line of credit. What happened there? Once she finished paying this $10,000 into personal line of credit, and that was gone, she again has 15,000 available to her. So in her case, it took her right about 8 months to completely pay off the $10,000 that she had taken from the personal line of credit, because again, she's paying the $10,000 off with the personal line of credit, and she's also making payments to these as well. But what happened after month number 8? She's got $15,000 at her disposal once again, and she takes the remaining $6,700 in student loan, and she starts the process all over again. Real simple way, again, repositioning your money. After 14 months, right? 1 year and 2 months after graduating, the entire $27,000 is paid off. And that's how she was able to more quickly and efficiently pay off and finish with her student loan debt. So again, I'm sharing this with you. You may think that this is too good to be true, but it isn't. It's about where you reposition your money and put it to work first for you. It's about using the right tool. I didn't want to make it a big, long, drawn-out video because you've seen those type of videos on this channel before. But I did want to just show these are some of the things that if you find yourself in student loan debt, especially if it's early, work on your credit, okay? Get a job. There's so many things that you can do nowadays to make some income. Save your money, right? Use your time wisely. And when it's time for you to pull the trigger and get a personal line of credit, all this is already going to be in place. You can get approved for a personal line of credit, even if it's $5,000, $6,000, $7,000, $8,000. So I hope this video helps. I know it was a blessing to my daughter, this velocity banking strategy, and I hope that is a blessing for you as well. Thanks for tuning in today, and to the next video. Look forward to seeing you again.